Hello everyone, Ryan Ponce with Compass, and today I'm going to go over a question that I get pretty often. Should I sell my investment property and should I do a 1031 exchange? So first off, I think when analyzing an investment property, you have to really think about what is your true return on your investment right now. And a lot of people, they naturally, they think, what do I have invested in the property? What did I buy the property for? How much money did I put down? And how much money am I making on that? And initially, that's the correct thought when you're buying a property. But over time, that value changes, right? You build equity in the property. The property likely goes up in value. If you took a mortgage, you're likely paying that money, that loan down. And so you have more and more equity in the property, and hopefully rents have gone up as well. And so when you analyze your return on your investment property, you need to think about how much equity do you have in the property and what is your return on that equity, because that's really your opportunity cost for holding the property. That is money that could be invested elsewhere if not in this property. So is it a good property to hold? So that's the first one. So I'm going to use an example for a property that I have listed in downtown San Diego right now. My client's actually doing a 1031 exchange, so they're going to sell this property and move the money into something else. They bought the property for $595, so $595,000. It rents out for about $5,000 a month, and right now the property is worth about $1,150,000. So after closing costs and everything, their equity in the property is about $1,085,000. So after you pay the HOA, property taxes, which the property taxes are lower because they bought for $595, and if it's gone up, the assessed value's gone up, but not to match the current market value. But even after, with the lower property taxes, and then you factor in HOA and insurance costs and everything, the return on that equity is only about 2.6%. So 2.6% is very low, and that money likely is better off elsewhere. So that's the first thing, calculating your actual return. And if you're interested in me doing that, I have a form on my website, on the article. If you're reading it there, you could fill that out, and I'd be happy to do an analysis on your rental property, whether you have one or multiple. The next thing that I get is it the right time to sell? And that's really situational. It really depends on the owner's situation. What is your situation? What would you do with the money? What would be your reason for selling? Is it strictly just to move it to a different investment, or are you just cashing out? So, but I do think that there are times in the market when it is more beneficial for investors to sell, and right now might be that time. Over the last 18 months, downtown San Diego has slowed down and it's kind of leveled out, it's plateaued. I'm not saying that values are decreasing or the sky is falling. I'm saying that the market has normalized, and we had a lot of growth from 2020 to 2023-ish, and during that time, values had gone up a lot. Now they've flatlined. Maybe it's the right time to take that money and to put it into something else. For the record, I do like the 5-year plan for downtown San Diego, the 5-year trajectory, because Horton and IQHQ's RAD Research and Development District, with the potential to bring in high-paying jobs. Now, those are office spaces, and the office market isn't very strong right now, so it might take some time to fill those spaces. But I do think that in 5 years, we could have a decently solid job market in the life science sector, like biotech. You may have noticed that I got a haircut in between topics. I actually recorded this video, the second half of this video, and it didn't have any audio, so I got a haircut and now I'm recording again. So one of the most common questions that I get is, what does my tax bill look like? Should I do a 1031 exchange? For people that are familiar with the 1031 exchange, that's a common question that I get a lot. If you're not familiar with the 1031 exchange, a 1031 exchange is a like-kind exchange. Essentially, you can exchange real property, so real estate, for real estate, you can sell and buy and defer your taxes. So it's one of the most common techniques used to defer taxes. And it's great if you own investment property and you want to roll that money into something else that might be a better investment in the long run. And so without paying the capital gains taxes. So there are rules behind it and everything. General rule of thumb is you have to buy up to take full advantage of a 1031 exchange. You have to buy for more money than what you sold for. That includes any debt. So if you sold a property for $1 million and you had a $300,000 loan on it, you still have to buy over $1 million in order to take full advantage of the 1031 exchange, even though your equity was $700,000. So just keep that in mind. The other thing, there's time constraints, and there's there's just certain rules behind it. So there's a lot of nuances. If you're watching this video on my blog, I have some of the general principles down below. But that is one of the most common techniques that people use in order to avoid capital gains taxes and defer them. Now, keep in mind, it's deferring your taxes. It is not forgiving your taxes. So you eventually do have to pay them unless you keep the property until death, and then depending on your estate's value, that may be forgiven. The taxes may be forgiven. So the other option is if you sell the property, if you have long-term capital gains, which means you own the property for more than a year, you will be taxed on any money made, any of the capital gains, and that rate is either 0, 15, or 20%, depending on your taxable income and how you file your taxes. So, that is an option as well. There is another option of doing something in the middle, which is doing a 1031 exchange for some of the funds and paying the capital gains taxes on the remaining balance. So I'm not going to get too much into those details, but it's extremely common right now because one of the biggest questions I get, or one of the biggest concerns that I get from people selling investment property is, what is my tax bill going to look like? And so the last thing I'm going to cover is kind of more of an opinion piece, which is this where my money is best suited? So I really like downtown San Diego. I really like the future outlook for downtown. I like the lifestyle. I like, living downtown. I like, having a second home downtown. I like all of those ideas. What I don't like is an investment that is almost purely banking on appreciation. So I prefer something a little bit more balanced, something that is cash flowing nicely, but also has, is an appreciation play. And downtown San Diego just isn't that market. And one of the main reasons is because the HOAs. So because the HOA dues are quite high in some of the buildings, they've been going up. It eats away at any of the returns that you could have potentially had, right? So for example, the Pinnacle unit that I mentioned earlier, those HOAs are $1,700 a month. Now, if you're living there, if you're living there, you're experiencing the building's amenities, you're benefiting from the staff, you're benefiting from all of the things that they take care of, that money, in my opinion, is worth it. But if it's a rental property, you're not getting that same value out of it. So just keep that in mind. I really like downtown San Diego for that, for living, for the lifestyle and everything. But as an investment, strictly from a cash flow standpoint, I don't know that it makes sense. So what I really like right now is the idea of buying 2 to 4 units. It's a very popular idea right now. I'm not the first one to come up with that. But buying 2 to 4 units, the rental market in San Diego is strong. It seems to always remain strong. There's always a lot of demand for homes, for housing. And I like 2 to 4 units because of our ADU rules. Being able to build additional dwelling units on multifamily is really like just a great point for later on down the road. So you can buy a duplex, a triplex, a fourplex, and you can plan on putting more units on it eventually, but you don't have to do it right away. It just adds a twist to the future value of the property. And keeping in mind that San Diego rents are really high, I mean, a lot of the central neighborhoods, North Park, South Park, Golden Hill, Normal Heights, all of these central neighborhoods, those ADUs are renting out really well, fairly quickly. And you can get, for a one-bedroom ADU, you can get $2,500 to $3,000 for a new ADU, depending on size and all that, obviously. But it's just a really good way to add future value down the road. And given that multifamily is valued by the money that it brings in, typically, it gives you an opportunity to add actual value to your equity as well by building these additional dwelling units. So it's not something that's inexpensive to build ADUs, but I think that the return over time is definitely worth it. I think the amount of money that it costs, but the amount of money that you get in return for the rents is well worth it. So if you have any questions about investing in investing in San Diego, about your downtown San Diego investments, feel free to give me a call, 619-228-6790. In my blog, in my article that I wrote, there is a button there that allows you to click it and put in your property information. If you want me to do an analysis on your investment property, I'd be happy to do so. Again, Ryan Ponce with Compass, and I hope you have a great day.